All right, it's 12:01, so let's get started. Hello, everyone. Welcome back. My name is Austin Hageman, and I'm here with the firm's Chief Investment Officer, Henry Mercer. Welcome to the webinar, Henry.
Thank you, Austin. I think the market's hotter than the weather outside these days.
That is true. So, as always, today we'll walk through some of the slides in our quarterly market update deck. The charts will highlight key data points that our investment committees consider when making decisions. As always, feel free to submit questions in the Q&A box. We'll address them throughout. And if we don't get to yours, we'll look to have someone follow up with you afterwards. So a quick overview on the firm, because we do have viewers who aren't current clients. We are an independent registered investment advisor providing unbiased advice and portfolio management to high net worth individuals through ultra high net worth individuals and institutions. We are a true fiduciary, meaning we don't sell products or get paid to push specific investments or any personal finance product for that matter. Plain and simple, our clients pay us for quality wealth management advice, and that's the only compensation we receive. No commissions, no kickbacks, no hidden agendas. Our investment teams have institutional access, giving clients a broad, unconflicted investment universe, along with access to multiple private banks, not just one like you may see at some other firms. Okay, let's jump into it. So let's start here with slide 22. So the big, beautiful bill has been a hot topic this last quarter. This is the Trump administration's massive tax and spending package, which is estimated to add $1.5 trillion to the deficit over the next 10 years, according to the CBO. So for obvious reasons, this has put fear of the deficit back in the headlines. Henry, can you explain what we're looking at here?
Well, we're looking at the percentage of U.S. debt to GDP, and also an overlay of the overall interest expense of this debt. What you can see is that the levels have reached a point where it's quite comparable to the debt that the U.S. carried back during the World War II period. There is some concern today, particularly on Wall Street, about this level and the rising cost of the debt. And you can see in recent years that the debt has increased primarily due to the medicine that was needed during the COVID era, the stimulus that was needed, and also the Biden stimulus programs early in his presidency. So the basic concern is that after World War II, the U.S. was able, with strong economic growth, to grow its way out of the debt. And that is the overriding concern now. So it is drawing a lot of attention, Austin.
So we typically don't see both U.S. debt as a percentage of GDP going up at the same time as interest expense as a percent of U.S. GDP goes up. Do you think that that's something to worry about?
Well, it's interesting. If you look further back on the chart, the percentage of interest expense went up in the post-World War II era because interest rates rose. During World War II, the Treasury anchored U.S. Treasuries to low yields, in a sense to try to monetize the debt, and that was discontinued in the early 1950s. We hear a lot now about the basic borrowing schedule of the Treasury now, that perhaps with longer term rates rising, particularly longer yields, that they might borrow more at the real short T-bill level. But, it's the cost of the debt that is the concern as rates rise.
Right. And I guess typically why we see these work inversely is because when interest rates come down, the Fed tends to buy back the higher interest rate debt and then sell, at the current lower interest rate level, right, to put more debt out there. So why you see this move. And then now we're in an instance where U.S. debt is going up and the Fed can't necessarily slow down the debt that they're putting out there. And we're in a high interest rate environment, which is what's causing these to rise at the same time.
And traditionally, the U.S. tended to slow down its borrowing during periods of economic growth.
Right.
And that really hasn't happened, I would say back to the George W. Bush years more recently.
Right. So I hear the scary headlines here. There's a big number assigned to our current debt level. And I get the long-term concern. But as of today, do you think the deficit is as alarming as the headlines suggest?
I personally don't, because I have a more optimistic view about the U.S. economy overall and its ability to grow longer term. And so I am not concerned. I mean, I've been in this business a long time. I can remember the early days of the Reagan administration. People were screaming about the deficit, and interest rates basically have done nothing but come down ever since throughout what they'd be calling a high deficit period. So I'm not altogether concerned.
Right. And just so it's clear for the viewer, when you say grow out of the debt, what does that mean?
It means that the U.S. economy generates above average GDP growth and essentially pays the debt down over time, that the growth overcompensates for the level of borrowing. And at some point in time, there has to be some sort of reining in of the growth of spending. You don't necessarily have to cut it, you just have to slow down the rate of growth.
Right. So it's similar to household debt in a way. I know it's not similar in many ways, but in a way it's similar in that if you have a high paying job, or you're, leaving college to then get into a high cash flow job, it is easier for you to take on more debt today because the funds will be there in the future. You'll grow out of your debt, so to speak. You'll be able to earn an income that is more than enough to offset that debt down the road, and you'll be rewarded for it in the long term. So, I look at this and I say, yeah, interest costs are now over 3% of GDP, which is high from a recent, historical standpoint, but it still seems manageable. And if we just, throw that back to the, on the personal level, to put this in perspective, many homeowners have gone through periods where their mortgage payment were 20 to 40% of their income. So that's 5 to 10 times higher than what the U.S. government is currently paying in interest relative to their GDP. So while, the debt headline sounds scary for a large, growing, and diversified economy like ours, it doesn't seem as unmanageable of a burden as maybe the news headlines are stating.
Absolutely.
There are things I think we should be doing today to help curtail and fix the deficit. But from a investment standpoint, it doesn't seem like our current levels are at a point where it's going to derail the economy and cause major investment implications now or any time in the near future.
Yeah, I would agree with that. But the main issue, like everything today, it's all politicized, and getting to the true meaning of everything is very tough. I mean, it's ironic that the Democrats now are screaming about spending, and the Republicans were screaming about Biden spending, and it is,
Right.
Ultimately what normally happens is the markets will force them, in a sense, to do the right thing. You just hope it doesn't get that far.
Right.
And that's the history of U.S. finance anyway, that there have been overreactions over time where we've had to get our act together. And I would foresee that happening in the future. There's no reason for that to change.
And this is a very easy pain point, I think, for the politicians to push on because it's misunderstood. It's a large number. It's scary. So
yeah,
for what that's worth. Okay, so let's move on a bit. So, on that same realm of U.S. debt, I love this slide because I think it hits on a common misconception. Henry, can you talk about what we're showing here?
Yeah, Austin, this is really a revealing thing here. All we read about is the enormous level of U.S. debt held internationally. And it's only 24% of the overall debt outstanding. And we also hear great fears about China, and that they would somehow have a capital flight out of the U.S. by Chinese investors. And if they would sell their treasury debt, and it would be catastrophic here. But as Austin notes there, it's only 2% it's much smaller than conventional wisdom perceives. So it's not a risk. And if you look at the facts, if you look at the numbers, it's just not something to worry about.
Right. And there is a sense of mutual destruction too if foreign investors, foreign governments decided to have a run on US treasuries, right?
Yes, of course. And they invest here for a very good reason, that we're the safest port in the storm. And the world realizes that. And it also has to do with trade flows and everything else. And there are certain countries that are outliers, but you look at the United Kingdom at 2%. Well, that really doesn't affect anything because most of that debt is held by their banks in custody for large hedge funds and sovereign wealth funds and things like that. It's nothing to worry about at all.
Right. And I think that's an important point to highlight. The US dollar remains the world's reserve currency for a reason. We have the biggest, most influential economy. The treasury market is the deepest market there is. Even among government debt, the treasuries are the most liquid and secure option out there. And there really isn't another currency currently in the realm of taking that over, anywhere in the realm of taking that over. The euro is tied to a fragmented political union. The Chinese yuan is not freely convertible. Gold and crypto are just too volatile and unscalable to treat as a reserve currency. And we also can't forget that some global markets, like most commodity markets, are priced in dollars. So that forces countries to hold dollars just to participate in those markets. So it's like using English as the global language of business. You might not love it, but it's the most understood, and changing it would be really expensive and complicated.
That's a great analogy, Austin. That's very true.
And that brings us back to the whole, debt conversation we were just having on the other side, where as long as the world wants dollars, the US retains a fair amount of financing flexibility.
I mean, it's not to say that everything is smooth sailing in a sense. Markets are always volatile in the short term. And, as the tariff discussions go on, there'll be rumors about this and that. But longer term, it is probably the last thing you should worry about.
So let's move on from the the emotional downness of talking about debt onto maybe something a little bit brighter, returns. So here on the slide, we are showing, basically where investors have found success so far this year. So here in blue, we're showing the total return year to date for different asset classes. This is developed market international equities, emerging market equities, high yield bonds, US large cap stocks, commodities, US fixed income cash, US small cap, and the US dollar. So we're also showing with the red diamonds here is the max drawdown so far year to date. So for example, the US stock market was down, had a max drawdown of roughly 19% year to date. And that is essentially the ride investors had to take in order to end up with the 6.2% return out of the US markets. So from a return standpoint, I think we should also note that if you were to take an equal weighted basket of the Mag 7, and there's an ETF for this, so that's how I'm easily able to pull this up. The names in the Mag 7, if you equal weight them, those are the NVIDIA, the Microsoft, Apple, Amazon, Meta, Tesla, Apple, they're all up less than 2% over the same period, performing worse than cash so far this year. So, Henry, what do you think about the returns so far that we've seen?
Well, what stands out first in terms of strength is international. You see that both developed market and emerging market equity have outperformed everything. And the second thing you note is that on the drawdowns, there's been a tremendous amount of volatility in the first half of the year. We went through the March through early April sort of panic that was created by the just sort of uncertainty around tariff policy and how emotionally things were rolled out. And the markets, in a sense, they panicked in terms of just the quickness and the steepness of the decline. You build up a tremendous amount of fear in a very short-term time period. which, as you can see here, it kind of ran its course, and the markets recovered quite quickly, which is historically very, very normal. And it was very, very bullish from a contrary standpoint. Some of the levels of fear, if you look at technical indicators, were comparable to what you might have seen back in the COVID period in March, April 2020, or even going back to early March 2009. It was just incredible how pessimistic things got.
Right. Now, I want to take a minute to break down both the international performance that you mentioned and then also the volatility we saw February through April, because I think that's important. But before I do that, I do want to point out that this international performance, developed market international of roughly 20%, is somewhat related to the weaker dollar that we've seen so far year to date. So the dollar is down relative to other currencies about 11%. Like I said, international developed is up roughly 20%. When you're a U.S. investor investing in international stocks, you benefit from or expose yourself from two return sources. One, the return of the actual companies you're investing in, and two, the return of that associated currency relative to your U.S. currency. So when we see the dollar come down, this isn't exactly, it's a little bit more complicated than this, but we know that the US dollar has added roughly an 11% return enhancement to developed market international for US investors, which has been great for those who have exposure there. So if we were to just look at international alone, we're still looking at a roughly 9% return. Again, I'm being simple with my math here, but that's still pretty solid, relative to only being 6 months into the year. But I just wanted to point that out so that was clear how the currency plays a role in returns there. So I want to jump into that international concept a little bit more. So what we're seeing so far year to date isn't unheard of, right?
Oh, absolutely. I mean, there are periods, and they are lengthy, where the U.S. outperforms international for long periods of time. And on the other hand, there are periods where the international takes over. And looking at sort of the long-term weighting of investment returns, there's kind of a reversion to the mean that takes over during long cycles. And the chart clearly shows that the U.S. is not always the most or the best performing index.
Right. So what we're looking here on the slide is when the blue line comes above this midpoint here, that's when the U.S. is outperforming international. When it drops below, that's when international is outperforming the U.S. So it's an easy visual representation of the different time periods when either international was outperforming U.S. or U.S. outperforming international. And I like to look at this because a lot of investors, and it's just a natural behavioral bias that we have, tend to focus on the short term, right? So they're focused on the last 3 years, 5 years, 10 years. And those have been very rewarding years for the US, but we can't just use that as our sample set. It's not a very big sample set at all. We need to look back even further, increase that sample set. And when you do, you see that there has been this trade-off. US hasn't always just outperformed because the US outperforms all the time. There was even periods after the tech, right? The initial, tech buildup in the 90s to the 2000s, that international outperformed after that, right? So there are periods where international outperforms. And what I think is interesting is I've seen studies where if you take out just a handful of U.S. stocks out of the S&P 500 index, so 7 to 8 names, I believe it is, the S&P 500 returns have actually fallen in line with international stock indices. So it really only took a few names, a few stocks that have done very well relative to global stocks in general to pull the U.S., ahead and give U.S. investors better performance out of the U.S. in the past, decade.
That's absolutely right. And I mean, one of the reasons for the U.S. outperforming for long stretches are those powerhouse companies that are domiciled in the United States, that we have a tendency to create the world's most dominant businesses with durable competitive advantages, and they themselves are global in nature. And that's where the U.S. has historically stood out. But you also look at the length of period that the U.S. is outperforming, and you go back to, let's say, the late 1980s up to the 2000 period. There are periods here in the U.S. that they call like secular bull cycles that last a long, 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 long time. And those at a certain point do, it's not to say the U.S. going forward would be a bad place to invest. It's just that we have grown to the point where value-wise, the international is just, in comparison, much, much more attractive. And we may be in the early stages of that here. What we're seeing early this year could be the beginning of a trend shift. And it could become probable just because 13.6 years is an awful long time to be outperforming.
Right. And we're seeing things like reduced spending here in the US, our government reducing spending in the US relative to other countries that are increasing their spending, which is helping to stimulate their economies more. Trump is pulling back resources from other countries. For example, helping with defense and secure other countries' borders, things like that, which is causing these other countries to spend money. I mean, someone has to protect their border, right? And that is causing growth, which is helping to spur, the returns that we're seeing. Now, the question is, will this continue, right? Will we continue to be spending less money? Will other countries continue to be spending more money, right? Will they actually make the investments, to keep pushing their stock markets higher and higher and higher? I will say that when you look at the data and you look at the nitty gritty, it doesn't take much for a company to go from being, 0.5% of the global stock market to one of the top weighted companies, which is what NVIDIA did in the past few years. Now, when I say it doesn't take much, it took a lot of investment and foresight from NVIDIA, and they're being rewarded for it. But what I'm more pointing to is, if it only takes about 7 to 8 companies, at least in the last decade or so, to cause that US outperformance, where are those next 7 to 8 companies going to come from? Do they have to be from the US? They might not be. And it may only take a few years for those companies to, hit the headlines and take off, right? We don't really know where it's going to come from.
No, that's an excellent point. It's just, you look at the S&P 500 right now. Historically, it's trading 23 times forward earnings. It's like a 22% premium to the historical the 10-year average. So the U.S. is historically very richly priced, and this is why you want to diversify your equity assets among different international capitalization weights, all sorts of things, because no one really knows what's going to happen going forward. And particularly if you're a long-term investor, diversification has really worked. It's really validated by all this stuff.
And, for the record, we're not calling an end to US outperformance. At the same time, we're not calling an end to international outperformance. But what we're saying, when you look at the data, there's a really strong case for not limiting your opportunity set, right? Having that international exposure to benefit from when international emerges as the top performer, having that US exposure, as well. And, maybe there are reasons for US investors to hold more US exposure because that's linked to the US economy, which we're actively, spending money in. So there are economic links there. But why reduce your opportunity set if you don't have to?
And we've heard for the last 13.6 years that the U.S. is not going to prosper, and we've lost the leadership to China and everything else. And look at the data; it hasn't happened, and may not happen.
Right. We actually have a great podcast with Mike Aroni, who you would recognize from CNBC and other financial news outlets. He was just in a few interviews on CNBC this past week. I saw him on. We had a great conversation with him. We go into detail on the why behind this international outperformance, his thoughts on if he thinks it'll continue. So if interested, you can find the webinar by searching for Amplified Wealth on any of the major podcasting apps. The episode was released in late June and is titled Weakening Dollar and Global Opportunities, Insights from Mike Aroni, State Street Global Advisors. So I said that we would circle back on the volatility we saw so far this year. So let's do that now. So we actually had a question come in before the webinar that asked, should we expect more volatility in the market while Trump is still making trade deals? And do you think there will be another pullback before the year ends? So referencing back to the previous slide where I put the pin in this, where we saw that the US stock market saw an almost 20% drawdown year to date to end up to where it is now, up 6%, which was from mid-ish February to the beginning of April. Given that question, and then also with this other concept in mind, is this volatility a sign of things to come, you think? Should investors be worried?
I wouldn't be worried about volatility, because volatility is sometimes more extreme than others, but it exists throughout the investment process. When you look at this chart here, historically, there are lots of corrections, there are lots of pullbacks, there are even bear markets, but the market rebounds back very quickly. It's only in those sort of secular periods where, let's say from 2000 to 2010, there was a decade of maybe lower returns, but the market didn't completely go away. The trend has been up, and history proves that. In the short term, corrections are normal. Seasonally, the stock market has a tendency to sort of seize up a little bit in September. We hear all the terrible news about October historically. October, ideally, is the best month of the year to buy. You buy those September, October dips, and you've done really well historically. I would expect some sort of pullback, because you look right here and now, sentiment is pretty speculative. And there is some question about the Fed, but I would welcome volatility. It's, as John Templeton had a saying, the great value investor, that volatility is the friend of the investor.
Right.
You get your ideal buying opportunities if you are long-term by buying into the weakness and buying when everyone is frightened. And that is consistent throughout investment history. There are no exceptions.
Right. The stock market is one of the few economic arenas where, when somebody waves a big sign saying everything's priced at a discount, people run away from it, right? When there's a store, when there's the Black Friday deals and the signs come up, everyone's running to the stores. But when the stock market throws that sign up, everyone's running out. So just to be clear with our viewers here, and then our listeners who may not be able to see this slide, what we're looking at right now is there's gray bars that go year by year, showing us the calendar year return for that year. And then the red dots underneath that are the max drawdown for that same calendar year. So you could see that there were several years, almost pretty much every year, there was a pullback of some sort, right? Even when the market was up. And then in some years, you saw a pretty strong down market and then above average returns. We don't even need to look back that far. We can go back to the COVID crisis, where the market fell 34%, but then ended the year up 16%, right? This year here, the market had an 11% drawdown, but ended the year up 31% over the calendar year. And what we find is that, we had a question come in. What does a drawdown mean? So a drawdown is basically from a high to a new low, right, in the market. What percentage did the market trade down? So the market could go up 10%, but then drop 20%. You start the clock at the up 10%, you follow it down to the down 20%, and that's your drawdown. But what we find is on average, and Henry, you mentioned this, on average, the stock market does drop annually, right? We do see a drawdown annually, and on average, that's been around 14%. And what we saw in April was down about 20%. So that's really nothing more than average. What I think is interesting is markets seem to crash quicker and recover faster, I think, as we keep moving forward in life. Do you have any thoughts on that?
I think that's probably true, Austin. I mean, part of it has to do with just the power of technology. Information travels, in milliseconds. It used to take a telegram or someone crossing the ocean to report news. It does seem to happen quicker. The market in the age of trading algorithms seems to react to news with less of a buffer. And so I think that's probably true. I mean, these you tend to have, it's like the COVID panic, very quick. It's the nature of the beast these days. So I think that's probably right.
Right. There's more real-time information. There's the algorithm, systematic trading, to your point. The central banks, I think, have been more aggressive with policy responses. Retail trading and media, that's all been amplified, right, through Twitter, Instagram, Facebook. I mean, people used to have to wait for the newspaper to come out to get their finance news, or they'd have to talk to a friend who talked to a friend who talked to a friend. Now you pull up Instagram at the end of the night, and you'll see information come across your screen about this risk, that risk, or what did the market do today, and things like that. So information's being delivered quicker, which would make sense why the market is pricing in things a little bit quicker, why that drawdown is happening quicker, and that increase. It's interesting. In the past, bear markets could drag on for years, right? You look at historical data. Now it's like a 15% drop, and a full recovery might all happen between your two dentist appointments. It's just that quick.
I mean, that's true. I mean, I think that the market's capacity has always had a capacity to discount, but these days it just happens so fast. And there was an old saying, if it's in the headline, it's in the price. And now it's like, if it's in the tweet, it's in the price. It just, everything is happening quicker. And that's, I mean, we've had computerized trading going back to the 1980s, but today it's wild how, like, the power of technology and the ability to analyze data it's grown exponentially. And it's changed sort of, it's changed. The quicker trading pattern is new, but it doesn't change the dynamics of what everyone should be thinking about as an investor. It's just, you want to buy into those declines. History clearly proves it. If the time to change your equity allocation, if you want to increase your exposure to the market, is during corrections, and you kind of buy and hold. I mean, history proves that. It's very, very difficult to trade stocks, more difficult now than probably ever because of the algorithms. I mean, if you think you have any chance of going up against them, it's impossible. That's why the Buffett method of investing in high quality businesses for the long term, taking advantage of bad times to make money, will not change, and that'll never change.
Right. It's really tough to be a retail investor out there. I mean, it's reasonable to expect the quicker drops when they do occur, right? And then the quicker turnaround, which may not always happen, right? That may be prolonged, but as a retail investor, to see them, a huge market shift within a period of a month, right, where the market drops 20, 30%, that's tough to hold on to. And then, we've experienced, recently these quick upturns. So there really isn't much time to think. There really isn't much time to digest the data. So if you're doing this on your own, if you're trying to just read the online resources, the newspaper, it's very hard to digest the information, really think about it, and then and then make a good quality decision in the time that the market's been moving. And, we also can't forget that just because we've seen these quick drawdowns and quick turnarounds, that's going to happen every time. What I worry about is when the investor gets too comfortable and we see a quick drop down, people flood money in, and then we see another 10 to 15% downside, because I think that would cause some real panic. I mean, on the flip side, it would cause some great opportunities for us to take advantage of. But from a investor standpoint, from retail investor standpoint, I do worry about that.
I mean, for us as professional investors, we have to react quicker also. The opportunities come up and it's just like you don't have as much time. So much of what we do here is we build up that memory bank of corporate fundamentals and things like that, so we can respond quicker. That's a big part of our job here these days. It's almost, there's an old saying like, invest and then investigate. Well, there's a degree of that you have to do now. You have to be fully aware of what the top companies are and the ones that you would buy during corrections. And that's something that, that outlook is something we maintain all the time.
Right. So let's flip to the next slide. Another slide we're ripping straight from the headlines, so to speak. I feel like what's that Dick Wolf show, Law and Order, here today, because we're taking one headline after another. AI. AI has been another juicy headline. Looking at a slide like this, which is showing us, based on a Stanford University and World Bank survey, what the expectation is for AI's impact on specific tasks, and that's measured in time. So we're looking at these different tasks, and the gray bar shows us how long it takes to do it on average without generative AI. The blue bar is the improvement with generative AI, how long it takes to do that task with the generative AI. Henry, what do you think about what we're looking at here?
This is really this chart just prompts so much questioning on my part. There's a differentiation between AI and how it impacts investments and how it impacts society. I mean, there's a front page article in the Wall Street Journal today, and the headline was AI is killing entry-level jobs. And I think that's probably the case in the short term, but history is filled with instances where some phenomenon comes on that enhances productivity and threatens the workforce. Yet, it's the nature of life that we continue to improve and expand, and the economies ultimately prosper. But this is one of these periods where there will be it will evolve into a situation where this becomes a tremendous productivity enhancement longer term. And ultimately, I would think society will benefit. But in the near term, there are lots of questions. And it also is impacting the corporate world and the investment world, because companies earnings growth has been good. This should help out corporate earnings, doing more with less people. You hear like JP Morgan, for example, has announced publicly that over the next 5 years, they will be reducing headcount. And their business is strong. Same thing with an Amazon. So this is a cultural phenomenon, and it will be, an overriding. It will override, everything we do. In I would think for the next decade at least.
Right. I think, when I look at the slide, I'm looking at, the operations analysis task going from 98 minutes to 31 minutes. Decision making in general, 79 minutes to 28 minutes. Critical thinking or active learning, writing, 80 minutes to 25 minutes. Anybody who thinks AI is just a tech story is missing out on the big picture. That's my takeaway here. This is a productivity story. And productivity stories touch the entire economy, not just Silicon Valley. if you think about it, every industry has repetitive manual or analytical tasks that are just ripe for automation. And that just screams, hello, AI. AI solves for this, right? That means, and if AI can solve for it, that means higher margins, faster decision making, better customer experiences across all sectors, whether it's finance, healthcare, retail, manufacturing, you name it. It could help increase the bottom line. I look at it. I look at AI as it's like electricity in the early 1900s. At first, it was exciting. It was exciting new tech that the utilities harnessed, and then it quietly just became the solution that powered everything, right? It was more about, these other companies leveraging that new technology, right? That drove profits for that company. And if you look at our utility sector, it went from something larger to now it's a much smaller portion of the U.S. economy. Mm-hmm. So that's what I think about when I think about it, when I think about AI, when I think about the slide here.
I listened to a short presentation that the CEO of Siemens USA, which is a subsidiary of Siemens, the German company. Her name's Barbara Humpton. And Siemens has been investing very heavily in the US. And she had just a much more optimistic view about how AI ultimately will create new jobs and will be in the long term a benefit to, as she would term it, humanity. So it's something that, she's somebody who runs a large corporation and businesses in the United States. And she talks, it certainly will benefit her businesses, but she feels that longer term, it's not a threat to society.
And that makes perfect sense. And that's a great point. To bring us back to one of our original topics of the webinar, debt and being able to grow out of debt, right? Have our GDP growth rise to an extent that our debt is not an issue. AI could be a solution here, right? We may not be able to cut our way out of this debt, but we might be able to grow our way out. And AI could be the engine that could make that possible.
No, I agree with that. It's just no one knows at the time. It's just the nature of, particularly the United States, of, it may have its faults, but the U.S. capitalist system has worked very, very well and much better than the rest of the world over time. And, it's the old joke about that what the automobile did to blacksmiths and things like that. Just stuff comes along, yet it's just the nature of the United States and our capitalist system. We prevail and we grow and we innovate and we encourage capital development. We just have so many things going on here. If you're in the United States, there's always uncertainty. There's always been uncertainty, but you've got to be bullish for the long term. The glass is half full here, and I don't see that discontinuing.
And now, just to be fair, the content committee here at the firm, we pride ourselves in looking at both sides of the equation, right? And as exciting as AI is, it is definitely, we should definitely remember that most companies aren't actually using it at scale yet. So we shouldn't get too far ahead of ourselves. We're still in the experimental phase. We're figuring out how to apply it, train teams, and avoid the risks, right? Right now, the productivity gains are more theoretical than measurable for many businesses. I mean, if you think back at other technologies, remember when people thought every business needed a fax machine and a website? I think we're in that kind of AI phase where it's cool to say you're using it, but few are doing it in a way that really moves the needle for them.
Ultimately, human common sense, and this is an old person speaking, obviously, overrides everything. I just don't ever, I feel like whatever the thing is, if it's art, if it's investing, that's just the human brain has that intuition that I just think you just can't beat.
Right. Yeah, I mean, I remember I mentioned the tech boom, the internet, which got me thinking about all the crazy websites that came out in that initial internet boom. You had the pets.com with the sock puppet. You had Webvan, which promised it was like delivery in 60 minutes, or I think may have been even 30 minutes. Which actually, now that I'm speaking out loud, that brings up another good point is, Webvan was basically the same concept as Uber Eats and Amazon's grocery feature now. So it was a great idea. And investors at that time were probably looking at Webvan and saying, wow, this makes complete sense. We need this. People are going to love it. It's going to be great. But it still failed because the technology and the infrastructure just wasn't fully built yet in the late 90s, early 2000s when that idea came to be. So there are, I would assume plenty of companies that are going to spout up with these great ideas and maybe grab headlines. But, it's not as easy as just, oh, it's a great idea, let me invest money in it. You need a lot of factors to come together and, make sense for the investment to actually work.
Mm-hmm. Agreed.
So, for anybody interested in AI, we're actually interviewing a few AI experts on our next podcast to be released in late August, early September time period. So definitely keep an eye out for that. So Henry, we had a question come in a little earlier. We have about 10 minutes left of this webinar, but let's see if we can get to this question and maybe some other things. The question is, do we need to plan for macro trends such as historic low birth rate, global trades being impacted by tariffs, uncontrolled national debt, or would you just buy and hold like usual?
I would, well, on the surface, yes, buy and hold as usual. It's just all these big macro worries throughout history. No one knows the answer. I mean, you even look at the best and the brightest. The world's greatest economists, they never forecast recessions accurately. The Federal Reserve has misforecast the economy for decades.
Right.
It's just the big macro view. The best thing is that deep down, you have to have a belief that, you're buying securities. You're investing in a business. You're buying a bond investing in a bond because you like the yield, you like the credit quality. You just can't get caught up in just the big macro worries because they're always around. And it's just, and you have to separate, honestly, investing from your thoughts about humanity and all that other stuff, because they're two different things. And the markets just have this way of looking forward. And if you're investing, it comes down to that you're investing in assets that you believe have value and will grow over the longer term. And so you have to be aware of, we are risk managers. We have to be aware of all these things, but no one really knows the answer. It's more like the markets, if you will kind of provide some sort of guide by the way they're behaving. But I mean, the talking heads just don't, they're terrible investors. And that's my way. I worry about it. I worry about it as a human being. I worry about the world my children are going to live in and my grandchildren. But it's just in the short term, it's unknowable. And as an investor, it's been a hindrance to think you have to be aware, but you don't want to be dominated by it.
The problem, I think, with chasing the headline is when you're chasing the headline, you're literally moving your asset allocation pretty dramatically, or buying a company based on a short-term theme, because that's really what headlines generally are. It's this sway back and forth, and we know soon as that data, that information that you read hit the knowledge base of the world, the market or the price is already adjusted for it, right? So when you're chasing the headline, so if you're chasing, the companies that are less impacted by tariffs, great, you moved into companies less impacted by tariffs, but then what happens when the tariff conversation is gone in 6 months, a year, or maybe 4 years when Trump's out of office, right? What does that mean for that company you held? So, to your point, Henry, if you're, instead of chasing headlines, you're chasing quality companies, quality investments, companies that have shown high cash flow, great use of that cash flow, good governance, things like that, then you're buying a quality company, and maybe you could slightly tilt the edges based on what's going on. But at the end of the day, when that headline gets removed from the headlines, when the tariff conversation is no more, you still hold a quality company, right? As opposed to then needing to keep making all these changes and then having to get the timing right each time. So it's very hard. And I think there's a difference between chasing headlines and then diversification. So to the points of this question of chasing these macro trends, and naming like the birth rate, the national debt, things like that. Part of that, I think, comes into having an appropriate asset allocation where you're diversifying for specific risks. We don't know when they're actually going to hit the economy. Generally, the things that hit investors the hardest are things that nobody was expecting, right? So how do you plan for that? And you plan for that through diversification. So along those same lines, and you mentioned you hit on this a little bit, Henry. So I think it's fun to bring up. We also had a question before the webinar about, are you bullish or bearish on the second half of the calendar 2025? My personal thought, I'm bullish. I think we should expect continued high volatility. So definitely buckle up. But I think that at the end of the day, Trump will react to market sentiment and do what he can to help support returns that Trump puts, so to speak, that you may hear the CNBCs and the Fox News of the world talk about. But with that said, studies have shown, where we look at market pundits and, every time that they make some sort of market prediction, right, we're only right about 50% of the time. So I wouldn't give any personal thoughts of mine or of anybody else's, for that matter, much weight. But another way to kind of look at this is, if we look at history, the S&P 500 has been up about 3 out of every 4 times over any 6 or 12-month period. Okay, rolling period. So if you're investing with at least a 1-year lens, the odds have historically been in your favor, even if it doesn't always feel that way in the moment. And just to add on to that, when the market is up over a 12-month period, on average, it's been up 21%. And when it's been down 13% on average. So it's like flipping a coin that lands on up market 3 out of every 4 times. That's not guaranteed, obviously. But then when it does land on heads, you get $21. And when it lands on tails, it only costs you 13 on average, right? And it's that compounding edge that builds real wealth over time. So, why stop flipping the coin, right? Why let some personal belief that the studies show really, it's really a coin flip? Why let that get in the way of the other coin flip where historically the market has gone up 3 out of every 4 times, and on the upside you've been rewarded more on the downside?
No, I agree with that. And in terms of, my view about the remainder of the year, I have to say my outlook is bullish, but it goes beyond the end of the year. As I stated earlier, the market is always vulnerable to corrections. This is there are all sorts of oddball things. I mean, this is the first year of a presidential term. Tends to be the weakest of the 4 years in the presidential election cycle. The market could sort of trade flat the rest of the year. We end up with a small gain, but the overall indicators don't show any sign of a bear market on the horizon. There's an old saying, there are 4 table legs to the market: Fed monetary policy, investor psychology, valuation, and then the overall trend. And right now, the Fed didn't cut yesterday, but they've cut 3 times already, and all odds are that they'll cut later in the year. And Fed easing interest rates is the primary, most bullish influence on stocks. Investor psychology right now is extended. People are a little giddy, but it's not over the top. The one risk thing is, the valuation. Valuation's high, but there's nothing in terms of trend analysis that says, the trend of the market is up. And so, I mean, I'm definitely bullish.
Right. And somebody asked a question: should you chase macro trends, i.e., technology and defense, which I'm assuming are more long-term trends? I think it's a good question to clarify. I think when you're an investor, you want to invest in quality and you want to invest in your long-term thinking. So if you think the technology sector is going to, be the best sector, for the next 30 decades, then, sure, maybe lean into that sector, or you think defense is going to be important for, a very long period of time. But it's trickier than that, because when you think of the volatility that goes with it. So defense spending, right now, geopolitical risks has risen. There's more in the headlines. That has impacted defense stocks, pretty well. And by the time we saw those news headlines, the market already reacted. That was already priced in. So are you just buying high, chasing the trend, and then selling low? And at the same coin, if you believe over the next 30 years that spending is going to keep growing, it's okay, but then can you also go through the periods of when it doesn't, right? Because you don't want to keep flip-flopping in and out. So I think it's important to look long-term, right? To understand that we don't have an information edge on the market, and that, to go in with your long-term beliefs, but then also be very understanding of that impact on, how a portfolio performs. Even, with defense spending, for example, does that mean buying the Lockheed Martins of the world? Does that mean buy cybersecurity companies? Does that mean, something else? I mean, I read in the headlines that the new battlefronts is, cybersecurity, and then also trade war, right? To manipulate the flows of an economy, and use that as a bargaining chip, right? Which we've seen Trump. That seems to be part of his positioning, right? When he wants to get something done, even if it doesn't involve trade, all of a sudden there's a tariff there, right, associated with it. So, where is that defense return coming from? Is it coming from our traditional defense stocks, or some new type of defense stocks, or is it coming from somewhere else? We don't know, and we need to acknowledge that.
And real quickly, Austin, that for example, you mentioned Lockheed Martin. They reported earnings earlier in the week, and they missed, and the stock was down like 11%, even with all the talk about the rise in defense spending. Where defense stocks have done really well has been in Europe, where there's been more pressure from the Trump administration for Europe to pay for weaponry and the like, to take the load off the United States. So
Right.
It's tough to predict trends in sectors. The best way, obviously, the long term for technology is very bullish, and will always need defense spending. So if you have an interest, you buy like a sector fund or something that would give you exposure there.
Right. And we'll also always need toilet paper. Yeah, I hope. Right. So, there's a lot of things we'll always need. But so there was one more question. We're just out of time, so I'm just going to answer this quick, because it's not a complex response. But just curious what your thoughts are on de-dollarization. What effect do you see that de-dollarization would have moving forward, if any? So we're watching the de-dollarization headlines too, but for now, they seem to be more smoke than fire. The dollar still has no rival when it comes to liquidity, rule of law, and trust. If anything, recent geopolitical instability has pushed countries even further towards the dollar, not away from them. So it's something we're looking at too. But right now, I don't think that is a huge concern for the U.S. dollar. Great.
I mean, they're dollar has been king for a long, long time. There's some thought that the Trump administration would like a weaker dollar here in the near term. So it's intentional and it's strategic. Longer term, who knows what'll happen? But it's a tough bet to see the dollar losing its status.
Right. Right. Well, with that said, thank you all for joining us. Please remember to, fill out the survey after this call. We really do appreciate the comments and the questions, and what you like, didn't like. We definitely take that into account. And then if you are watching the recording, please remember to like and follow on whichever platform you're on. We got to fool the bots into thinking that we're really good at this. So we appreciate it. Thank you all.
Thanks, Austin.